we go. Okay. So we'll call the meeting to order. And first item on the agenda is I guess we don't need to take attendance anymore because we're not doing this via Zoom. Approval of the minutes of the March 17th meeting.
I'll move approval.
Second.
All right, any comments, changes, additions, deletions? Hearing none, I'll call the question. All in favor?
Aye.
Aye. Okay. All right. The next item is the Historic Cemetery Trust request.
I actually put that on because I knew that they were going to the city council Monday night. I have not received any further correspondence yet as far as the request for monies. So basically,
Table to the next meeting.
table till the next meeting, just because.
Did it get
They-
addressed at the?
They did approve it, but
Did approve
we're
it.
still required to get a written
Yeah,
request from.
okay.
Right, exactly how much. I think they approved up to 2,500.
That's
right, yeah.
But my understanding is that they'll provide the backup for exactly how much they want. We have not received that yet.
Okay.
So-
All right, so we have a motion to table. Do I hear a second?
Second.
All in favor?
Aye.
Aye. Okay.
So I don't have any checks to sign.
What is it?
So, not this month anyway.
No checks?
Yeah, no checks.
You got no money?
Well, we got money. We're just not issuing any checks. Yeah.
What's this? David Moore, Community Development Director? Oh, this is when this was,
Yeah.
I see, okay.
Long time ago, yeah, quite a few years ago.
I did see David.
You did? How's he doing?
He's doing well.
Yeah.
He's king of the hill over there in Greenland now.
Yeah.
No, Stratum.
I'm sorry,
Stratham.
yeah, Stratham, yep.
Yeah.
He was at Nancy Keimer's
Yes, he was.
retirement thing. Were you there?
I was. I didn't see you.
I meant to go.
I felt bad I had to miss that.
All right, any other business anybody wants to talk about before DD gets here?
So I didn't know if, Dana, you might want to elaborate a little bit on what you were looking for as far as the ESGs. I did forward everything over to John, the little report the sample report that you had gotten. So as far as, ESG investing goes, I don't know if there's anything.
No, I don't have any preconceived notions.
Okay.
I just feel in my travels, this is topic du jour, and all these investment managers are making offerings available. And I thought it was just by happenstance I happened to speak with a gentleman from Durham, and they were pursuing a different investment advisor, and ESG investing was going to be one of their priority concerns. So, and what you saw was how they had handled it.
Okay.
And I think I had, in conversation with Tom, had mentioned the reason it came about in their case and why they pursued it was because of citizen action and concern. And we had that one letter.
We did. We had.
And at some point, I think we just have to recognize we might be getting more inquiries on the matter.
Fair enough.
Yeah. So they received that. They also had received earlier the summary sheet we were looking for,
Yes.
We'll see what they come in with.
right?
Yeah.
We don't have any trusts that got $2 million in it that can be used for Michael Caine, do it?
No. No.
Oh, did you see that, Tom? The lawsuit?
Yeah, well, I saw the article on it. Whenever those articles, I always love to print out the complaint just to see what their pitch is, so I haven't got one of those yet, but I'm interested.
How do you access the complaint?
Well, lots of times their links, not so much with the Herald, but with other newspapers, they give you online versions. They'll give you a link right to the
To
complaint.
the filing of the suit?
Yep.
Really?
Well, if you're in a butter, apparently you automatically can file to get a copy, according to Bill Down.
Okay, with the court, you mean, or with
With
the
the court.
city? Okay, yeah, yeah. Yeah, you can nowadays, because a lot of the filings are done electronically, you can file to, particularly in federal court, I could go on to any lawsuit and file to receive copies of the decisions as they're issued. This isn't a federal court one, but that's a clear wave of the future. Who is the counsel?
It didn't say.
That didn't say in the paper, that's why I was curious.
Yeah, I don't know. A strange group of names.
Yeah, it's some different names in there.
Yeah.
I didn't know most of them.
Well, Silverstein owns a lot of property
Yeah, I know
on
that
the
name.
commercial alley.
Yeah, I know that name.
Bill Downey, of course, I knew. It was different from the names of the normal lawsuits.
Right. You gonna say something?
I was, just an update on the monies that was in the Bangor savings account that we were going to move. Tom, I need to get with you. They need you to go in. Again, they're asking for the chair to go in, just like they did at one of the other banks. If you could
Okay.
go in, and they will just have you sign off on it and issue the check. So that
Give me the check and I'll bring it to you? Okay.
yeah, we'll make it out to City of Portsmouth. I'll send it all to you in an email again, and then whenever you're ready, you can go, if you could stop over sometime in the next couple of weeks and get it.
Okay, so there's no time
It's no
sensitivity?
time
Okay.
sensitive, it's just that we wanted to move the money out
Yep.
of that account, so.
Well, if you-
I did hear back from them. It took them a little bit to get back to me, and they were like, I'm not authorized to go in and get it for you. They said if the chairman could come in, and I said, well, it shouldn't be a problem.
They don't let you get the signature card for them?
They said that literally they want an ID
Oh,
and
okay.
everything when
Yeah.
they go in.
All right.
So the days of me being able to,
Yeah.
with bank fraud and everything, you just can't do it the same way anymore.
All the boat slips spoken for?
Spoken for, and the city's received the monies for them. So in fact, I think a couple of boats are supposed to be going in very, very shortly. So, yep, spoken
So-
for, and with a big wait list.
With a big weight, that was my question,
Yeah,
yeah. That's
yeah.
awesome.
Yep, and a lot of people have been calling that aren't even on the wait list. How long is the wait list? Can I get on the wait list? I'm like, I don't think that you'll see a slip this season.
So were most of them Portsmouth residents?
They were all Portsmouth
All
residents.
Portsmouth residents.
And everyone on the wait list is from Portsmouth,
That's incredible.
yeah.
Well,
Time to raise the rates.
yeah, well, seriously.
Seriously, it's something that's probably going to come up for discussion again.
That goes through that-
Obviously not for this season, and it won't be for 2023. It will go through the fee committee, and that will be for fiscal year '24, because they've already met for fiscal year '23.
Well, that whole situation has worked out fabulous. Better than I ever expected.
Yeah, and Peter Rice has done a great job with Prescott Park and the overseeing of Prescott Park. He's got a great staff over there, and then the rec department has got the doc, Tim Bailey, who's great. He's been here forever, and
He is a jack of all trades.
he really is. He really is, and he's a nice person. So we've got a
Don't
good
tell
group.
him that, though.
He's going to know if he watches. They've got a good group. They've got a good group, and so we've got the flowers ordered for Prescott Park and all of that good stuff. So things are moving right along, and the reservations for Four Tree Island are being handled by the rec department. So and the weddings are being done by the city clerk's office. So it's all being handled very efficiently, which is great. So,
Well, I expect that the Arts Festival is hoping for a big summer after a
sure
couple.
they are. Yeah, they've come in with their agenda, their schedule, and that's been approved, and they're ready to go, and
They had a few more concerts approved.
They did. They did.
Yeah, I haven't seen the schedule.
Well, they
They keep announcing them.
I think they came in with an addendum or something.
yeah, they
blocked
got
the
some
time.
off. While school's still in session, they had a couple they wanted to do, and council approved it.
So, yeah. How's the master plan going?
Well, we're trying to figure out how to get some money at this point. In fact, we applied for 2 grants
Oh, good.
last week. One was a state coastal flood resiliency grant, and the other one was a federal one. You know, each of them were $2.5 million grants. Now, that doesn't mean we're going to get either, or doesn't mean we get 2.5, but the state one in particular, there's about 4.7 for the 20 communities that are considered close to coastal New Hampshire. And so that money would have to be split by how many communities applied, but, you know, we've got enough money in already approved CIPs to do most of the infrastructure, but the big thing that has thrown us off is as a result of the climate change,
Seawall.
floodwaters and high water tables, we're gonna have to move Shaw and build an addition on Shaw. And so that's a big ticket.
Tom, you don't qualify, you wouldn't qualify for any of this infrastructure money?
That's part of what we've got the application in for.
No, that the city has.
You mean the ARPA or something like that?
They get $12.5 million.
Yeah, I think
I don't
they've
know
already
if it's-
spent that,
I
but
don't know what's earmarked.
Well, no, they haven't, because they got 6.4 that's coming in May.
yeah, but isn't that what the council approved
That was last year's.
on Monday? They took a lot of
Yes.
votes Monday.
Yeah, that was to reallocate it from the community campus to other projects, because the community campus was going to be a problem using that federal money for. Now there's another 6.4 that'll come this month, or next month, May, and they're looking for ideas on how to spend that.
Okay. I thought that was part of what was voted on Monday
No.
night, but okay. Well, I can tell you, we've got our hand out to whoever's willing to listen to us. You know, we still got a lot of permitting to do,
Yeah.
DES, Historic District
I was
Commission,
going to
et
ask if you have to
cetera.
go through the HCC too. Yeah, I mean, any questions regarding that, I would shoot over to Judy Belanger, Finance Director.
Well, I've been working directly with Peter and Karen
There you go.
Daglin.
Perfect. They'll
So-
know.
It would be nice if we can find some money and go forward on that.
You going to do a fundraiser to raise funds at all? Or is that
After
down the road?
campaign.
What's that? Well, I don't think any decisions have been made as to when and how, but the original master plan
Called
envisioned
for it.
it would be a public-private partnership. You know, the difficulty at this stage, which is the primarily underground utilities infrastructure, that's a hard sell. Once we kind of can get past that, and then we can show the vision of what the new park will look like, I think there'll be an effort to raise monies in the community.
Who's the new council rep on?
Assistant Mayor?
The
Yep.
community scholarships got 1 or 2 more donations online, so people are starting to use that, so that's great.
Well, you know, that press release we issued continues to make it in the
Yeah,
paper.
yeah.
Just about like 10 days ago, Stephanie sent me a copy of another, so I bet you that's
Yeah.
where it's coming from.
Yeah, which is a good thing, so once people get used to having it out there, but we have seen, we had a $100 donation come in, and I think a $50 donation come in, so.
Anything on the funding of the other scholarship?
The Tommy McCann one?
Yeah.
Yeah, no, I know that Kathleen was going to reach back out. She said that sometimes it takes a while for the estate to go through its final settlement. That's kind of what she was waiting to hear back, but she said she would reach out, but I haven't heard anything further on it. So,
It is seeming to take a little longer than I expected.
Yeah. I mean, it sounded like, well, you and I got the call. It's over a year ago.
Oh, well, considerably over a year. And I got the impression they were going to release the monies early, even if the estate needed to be wrapped up, but maybe that's not.
I know that we haven't received any monies. I know that, so. I don't know if anything's started to be drafted or anything like that. Legal, I have no idea. I haven't heard anything.
Restaurant Week is back. I'm going to miss Restaurant Week this week.
So when you're down in Hilton Head, do you ever get into Savannah?
Actually, we land in Savannah.
Yeah. But you ever go in for dinner or anything?
We went, we took a boat trip one time and took a tour and had lunch and then took the boat back. But that's the extent of what we. How long did you and Tom Morgan stay outside?
Too long. I was chilled, but
I was going to say.
I know we were probably about half hour. Well, good morning.
Good morning.
Good morning.
Morning. Hi, John, how are you?
I'm great. How are you?
Good, thanks.
Great to see you all.
I don't remember these. These are fancy.
Win from DC.
I did. I see you had a visitor yesterday other than me.
How come you didn't book a ride on his plane?
It's okay.
Ready to get shot down? So
To
just,
fly without a mask. That was very fun.
Let's see.
well, so just as I said to the other folks here, I have a little head cold. I did test myself at home and I was tested negative for COVID, but I'm happy to wear a mask if you're more comfortable with it.
I'm living dangerously.
Okay.
After not really getting sick for 2 years, I got sick for the entire month of, what is this, April 20th? Like late February through about 2 weeks ago.
Wow.
Started with tonsillitis, which I've never had in my life. And then I hung out with my 2, 4, and 6-year-old niece and nephews for a weekend.
That'll
Managed to
do it.
catch everything they spread. That turned into a head cold, and then
You're making me nervous.
Stop. Well, I'm not the
Might
only
wanna
one,
move,
right?
Dana.
I'm printing that.
There's stuff going around, but I finally feel immune to everything right now.
Well, I think everyone's been slathering themselves in hand
you've been wearing a
sanitizer.
mask.
So now if you get the slightest thing, it's going to knock you down.
Thank you.
Listen, I printed this last night,
Oh.
and I told Tom walking in this morning, if I'm going to have to continue to do this, the next time I'm in TD, I'm going to ask for a couple of reams of paper.
Yeah, I apologize for
two.
the 43 pages there. I will, hopefully it'll make you feel better to know I'm not going to walk you through all 43 pages, but I do feel obliged to give you the detail on all 4 portfolios, even though it's more information than you probably want. And I will always bring copies for you.
Okay. Or you could get them to us ahead of time.
Yeah, I apologize for that. I said to Suzanne yesterday they should have gone out to you Monday, and you didn't get them till late yesterday. So
Yeah.
All right, you have the floor.
Okay, so everybody's got the main deck here, and let me just also pass out, we won't go through this in detail, but it was an attachment for you. For Judy. So if I can start you with the big deck, the 43-pager. And just in terms of an agenda this morning, and please tell me, how much of your time do we have?
Well, you're the only thing left on our agenda, so we would like to, go home before dark, but we're willing to give you as much time as you need.
Okay. So on the agenda for our purposes, I want to walk you through the portfolio detail that I brought, talk about balances, reporting, the model, some changes that I will throw out there. And then Judy had highlighted to Suzanne and I think on Monday, that we wanted to have a discussion around ESG.
Right?
And then lastly, she had shared with me some reporting that she's been working on, and so save time for that as well. Is there anything else that we need to fit in today?
Just to clarify on the idea of the reporting, one of the things that we had asked her to send to you a while ago was, I think each of us thinks it would be helpful if we had some type of a summary sheet or a dashboard that we could get every month, because the current statements you receive just have each individual account. There's no
Right.
consolidation, there's no, you have to dig in order to get the questions answered.
Yep. Perfect. So we'll chat about that. So with that, let me
Did you
start.
bring any ideas?
You want to start with that part?
Well, no, but I did.
In preview, I am confident that we can get you everything that you're looking for. The only challenge is I can't do manual. I can't provide anything to you that isn't system generated by TD. So what I can do is, Judy's actually, it seems to me, already sort of mocked up, that must be an Excel that you created that?
That's correct.
Yeah, what I can do is help Judy build whatever summary you need from the data that we provide so that you've got the dashboard you need.
I mean,
We do that. You do that now anyway.
I do.
Yeah, well, let's
Okay.
go through the review and then talk about the ESG and then talk about that as our last item.
Sounds good. Okay. So if I can direct you to it says page 4 at the bottom. So this deck is organized by all 4 portfolios, and I just want to tell you at the outset, the first 3, scholarship, endowment, and housing endowment, all have exactly the same model. So I'll go through it in detail, and then Prescott at the very end is almost the same. So I'm really going to speak primarily to the first 4 or 5 pages here, but we can go through any of the other additional detail as you wish. This is, if you look at the upper left, second row down, you can see this is the scholarship fund. And just at a high level, when I say they're the same model, the first 3 portfolios are identical. Prescott's a little different. Where they're different is with the first 3, we have an allocation to dividend-paying stocks, as well as a REIT, holding in real estate investment trust, as well as a slightly higher allocation to high-yield stocks. That was all intentional when we built the portfolios, because those were the 3 who were subject to income-only distributions. So the intent was to try to construct a portfolio with a higher level of income. Okay, Prescott, conversely, has got slightly less high yield and no explicit exposure to value stocks, even though by virtue of its S&P 500 holding, it of course, has about half of the value stocks that are out there in the S&P 500. So with that, if I turn you to the table in the upper left, first column there, you can see that this is at March 31st, so a few weeks ago, scholarship fund was at $10.2 million. And then if you go down just to the bottom of that table, you'll see $10,004 million. That was the systems calculation of the inception value. So when we built the model and turned the system on, that was the value. It says May 28th, 2021. So we're a couple months shy of a year. you can pretty quickly do the math, right? You're up 220,000 on 10 million. That's just over 2%. And if you look at the table just below that, and you look at the column labeled investment, that's the time-weighted rate of return for the portfolio net of fees. Okay, so 2.18% since inception. We gave back about 5% in the first quarter, which you can see year-to-date or quarter-to-date, same number. And then that benchmark is not an apples-to-apples comparison to your benchmark. That's just a system-generated benchmark that gets applied to pretty much every portfolio with roughly 75% equities. It has no emerging market, no small cap. So I created a custom benchmark for you, which I'll show you in a couple of pages. Okay, just as a better comparison. Very bottom of the page, you can see the yield on the portfolio is just over 2%. So going back to my comment earlier about the differential between these three portfolios and Prescott, Prescott's yielding about 1.8. So we're picking up roughly an extra 20 basis points. Now keep in mind, when we built the portfolios roughly a year ago, rates across the whole yield curve were, below 1.5%. So it was really difficult to pick up a meaningful yield, regardless of what we did. But 20 basis points is the difference that you see there. And you'll see that grow over time just based on the movement in rates that we've had. On the right-hand side of the page, I'll start with the pie chart and just remind you, blue and purple, shades of blue and purple are equities. Gold, brown is fixed income, so you can pretty quickly see it's 75% equities, 25% fixed income. And then if you look at the table to the right, we get much more granular. Largest exposure across the three portfolios is to U.S. large cap stocks. You can see the large cap core holding is the largest in the portfolio. That's your S&P 500 index fund. We've got 2 allocations to a large value dividend strategy in the portfolio. Again, that was for yield. 5% allocation to SMID cap. That's small and mid cap, a 5% allocation to REITs, a roughly 13% allocation to international across the MSCI EFA and developed markets and an emerging markets ETF. And then within your 25% exposure to fixed income on the bottom, you're diversified across 2 intermediate bond strategies, which is a little more than half of the portfolio, as well as an exposure to high yield and cash. Now, we'll come back to this after the ESG discussion. I don't want to propose any changes on top of any additional changes that we might be considering, but I will just tell you while we're looking at this particular chart that TD's current asset allocation committee views with regards to tactical adjustments to a portfolio. We're currently underweight international from when we built the portfolio. So if you said, John, yeah, let's go ahead and implement that, I would take international down from roughly 13% to 10%. We're overweight large cap value, which you're already expressing in this portfolio if you look at the third line down by virtue of that allocation. So
What's that, the 11%?
Exactly. Yep. But we are not expressing that in the Prescott portfolio. So we could add an allocation to large value if we so chose.
So what's the allocation on the TD?
Yeah, so there's no one right answer to that because it depends on the specific risk objective, but in a 75-25, an overweight would be somewhere between 5 and 10%. So
Okay.
in the case of...
All right, I get it.
Yeah.
So we're 11, so that's why we're overweight.
No. The reason we're overweight in this portfolio is because we built that into our original portfolio, Dana, just to generate additional income.
Okay.
We wanted more dividend stocks in these funds.
But I guess all I'm asking is,
If we had no value dividend exposure today, the overweight would probably take us to 10%. So for example, on Prescott, where we have none, if we were to express that, I'd add a 10% exposure to large value.
Okay.
And then we had an overweight to investment grade corporate bonds, which we have expressed in these portfolios. We're now neutral corporate, so I'd probably dial that back a little bit. And then lastly, we're underweight now high yield. Interestingly, high yield has been the best performing part of the fixed income portfolio, but it's an exposure. So if we wanted to express that, I'd take high yield down to 4%. So, these are minor adjustments, but ones that I would definitely support. On
Wait,
the
down to 4%?
4% from roughly 7.5% in this portfolio.
Oh, okay, you're considering the bank loan high yield?
Yes.
Yeah,
Yes.
okay.
Yep. So again, I'd like to get through the ESG discussion first, and then we can come back to that. But I would support all those tactical adjustments. I would tell you, the biggest exposure that we have in the portfolio, 75% stocks. So the biggest exposure we have is to just the overall stock market. But within fixed income, we do have exposure by virtue of our slight overweight to corporate bonds to spreads widening. If we end up, if the Fed makes a mistake and over tightens and we end up in a recession, spreads will widen. We can't predict that, but that's what we're trying to protect. So we'll come back to that. With that, let me turn you to page 6. Page 6 is giving you just a longer-term view of performance. Now, again, we don't even have a year to look at. But if you look at that table in the upper left, you'll see the middle column, TWRR is time-weighted rate of return, net of fees. You see the same negative 5.08 for Q1. And then what's new on this report is 3 lines down or 2 lines down, you see COP IPS. And so that's my short cut for City of Portsmouth investment policy statement, and you see minus 5.21%. Okay, so what that allocation is it's, I'll tell you specifically what it is. It's 50% S&P 500, 10% MSCI EFA, 5% Russell 2500, 5% REIT, 5% emerging markets. It's the asset allocation that's detailed in your investment policy. Okay, based on the target allocations. So that just gives you a better apples-to-apples comparison to the way we have the portfolio constructed. Now, obviously, there's no fees. It doesn't precisely align with your allocation in terms of exact percentages, but you're paying 20 basis points in fees. We shouldn't see a dramatic difference between your performance in any given quarter and your IPS target weightings as currently constructed. And you see that as you go down the line. The last thing I'll point out on this slide is these funds were really activated in late May or very early June. So we had 1 month of the second quarter last year and then a full Q3. So, again, we're not at a point yet. This is basically 10 months of data where you're seeing they don't give you a full Q2 2021 just because it was only a month. But it is captured in the very bottom number, which is inception to date of 2.18. And then just for additional, and just lastly on this page, if you look at the bottom right, you see the growth versus benchmark, that chart. That was one of the charts, Judy, that I think was on, how is just the portfolio done over time?
Right, I think that was.
Yeah. Yep. So I just wanted to point that out to you.
Which benchmark is that?
That is the, blue is the, that's a good question. That is the standard benchmark. The system default benchmark.
Mm-hmm.
And that's something, Judy, we can easily add to the Excel reports just to try to get it all in one place. But when I looked at what was asked for across those pages, I don't think there was anything that I didn't have. It was just a question of where it was and what report it fell on. And then if you turn to page 8, this is giving you, and so there's 2 identical reports here that look like page 8. This is performance by holding within the portfolio. And so if you look at the far left in gray, you see your specific holding. So I'm on page 8. Just looking at the top left, you see the Fidelity 500 index. So that is your exposure to the S&P 500. That's a passive ETF strategy with a 1 basis point expense ratio. It's the most cost-efficient way I have to offer you exposure to the S&P 500. You can see the percentage allocation, 41% in these portfolios, shows you the style name, and then it shows you the start date. So this is really as close as I can get to inception on this report. And then you see the performance from the start date. And then below that, you see a benchmark comparison. So on this report, and this is as of March 31st from inception, large cap core, that very top line item has been the strongest contributor, with the exception of, if you look 4 lines down, you'll see the REIT was 9.4% over this time period. Large cap core did better than large cap value. So if you look at the 2 large value holdings below that, the Vanguard Dividend Appreciation ETF and the Vanguard Russell 1000 Value ETF, almost twice as good of performance out of large cap core over this time period. Emerging market was by far our largest detractor. It's also our smallest allocation, but emerging markets have really struggled in light of China's slowdown relative to COVID, as well as their ties to Russia with regards to the war going on in Ukraine right now. On the fixed income side, over this time period, your bank loan fund, which is 1, 2, 3, 4, 5 up from the bottom, 1.42%, you'll notice is the only positive contributor on the fixed income side. So this is significant. This is the most risky allocation that we have in fixed income, right? High yield are all below investment grade bonds, and your bank loan fund is the only one that's been a positive contributor. The allocation here has benefited you in 2 ways. One, the income that this asset throws off is the highest amongst your fixed income holdings. And secondly, bank loan, I'll just remind you, bond prices move inversely to interest rates. So when interest rates go up, bond prices go down. There's no getting around that math. Bank loans are floating rate. So all the fixed income instruments in this product are floating, and so it significantly mitigates the risk to rising rates because they're floating. As rates rise, so do the returns on these bonds. So we've benefited from that. However, they are not risk-free. These are all below investment grade credits, and what they're really susceptible to is spreads widening, and there's no getting around that. So it's been a good holding. It's worked for us so far. We'll conclude later whether we want to trim it.
Can you explain what you mean by susceptible to widening
Spread widening?
spreads?
Yep. So let's take a simple example where an investor is trying to decide between buying a 5-year Coca-Cola bond and a 5-year U.S. Treasury. Well, I think we would all agree that you should be paid more for taking the risk of Coca-Cola defaulting versus what we perceive to be the risk-free Treasury asset. So if a 5-year Treasury was at 2.5, you'd expect to earn something over 2.5 to take Coke credit risk. Well, let's say today that spread is 40 basis points, okay? So if the market decides tomorrow that Coke is now a riskier credit risk and that spread should be 80 basis points, that's equivalent, Dana, to a 40 basis point increase in rates. So even if 5-year Treasury rates stay unchanged, if the market determines that we need to earn a higher spread to take the risk of buying Coca-Cola paper,
Yeah. No,
it's like an interest rate increase.
No, I get that, but isn't that risk somewhat mitigated by the fact these are floating rates?
That only protects you from interest rates going up, but if the spread that investors demand changes,
Yeah, I-
that's equivalent to rates going up. Yeah.
But-
So it protects
but-
you from rates rising, but it doesn't protect you from credit spreads widening.
The
But-
underlying cost of the bond.
No, right, but these are mutual funds, right?
Yep.
So aren't they constantly reinvesting and capturing rising spreads in the fund?
Yes, with their new cash or
Yeah.
cash that comes from coupon payments that doesn't get distributed, but on any given day when the portfolio is marked to market from a pricing standpoint, any bond that they hold can depreciate if spreads widen. just purely price. You're right that the yield will go up, but the price can still go down.
Okay.
Yep. And then, so that's the time period from inception. And then if you turn to page 10, this is showing you just the first quarter. So exactly the same data, exactly the same format, just a different time period. And here you'll notice, the first quarter, there was no place to hide in the first quarter of this year. Traditionally, you would think of bond portfolios as acting as a cushion in the event of stock selling off, but we've been in a rising rate environment, which negatively impacts bonds, and we've seen higher levels of equity market volatility in light of the events of the first quarter. So as you look down this page, just a couple of things, all negative returns on the equity side, all negative returns on the fixed income side. But what are the themes that have emerged this quarter? So if you look at the top line, S&P 500 down, call it roughly 5%. 2 lines down, look at your Russell 1000 Value Index, down less than 1%. So in this first quarter, value style stocks really outperformed. The REIT wasn't immune from the downturn. And then again, going down to fixed income on the bottom of the page, high yield was best again. You can see your floating rate. This is 1, 2, 3, 4, 5 lines up from the bottom. Your bank loan fund, these are the floating rate high yield bonds, basically flat. Your fixed rate high yield fund, which is second from the bottom, minus 4.5%, both better significantly from the Treasury exposure at minus 6% and the corporate bond exposure at minus 8%.
Wait a minute, where's the Treasury exposure?
It's the 4th lines up from the bottom. Yep.
Fourth? 1, 2, 3.
Minus 6.28. Sorry, 4 gray lines.
Yeah, okay, 1, 2, yeah, okay.
And so again, nowhere to hide in the first quarter. That said, if I had a crystal ball and I was looking at it on December 31st and it told me that in the first quarter of this year we were going to see a near 150 basis point increase in rates, that the Fed was going to go from a fairly dovish stance on the markets to a dramatically hawkish stance with regards to not only raising rates for the first time, but talking about possibly raising rates in 50 basis point increments going forward. If you told me that Russia was going to invade the Ukraine, if you told me about the Omicron variant, if you told me, China was going to lock down a city of 20 million people, I would have guessed that we would have seen stocks off significantly more than, the 5-ish% that you see here. So by and large, stocks have held up remarkably well in this environment. Going into the year, TD was actually pretty constructive on stocks. We didn't expect to see, mid-20s type returns like we did in 2021, but corporate balance sheets are exceptionally strong. We were optimistic about just coming out of the COVID environment and the overall reopening of the economy. This is success that we've seen in the inoculation of the country and just overall sort of herd immunity with regards to COVID, et cetera, et cetera, et cetera. And so I think that strength, you got unemployment well below 4%, U.S. GDP, north of 5%. Inflation, was sort of the big variable. And we did expect the Fed to tighten this year, probably not as aggressively as we think they're going to. But all in all, I've been pleasantly surprised with how the markets have held up. And then lastly, the damage is probably done on the fixed income side, meaning right now, the yield curve, so U.S. Treasury rates from 1 month out to 30 years, most of the curve is north of 2%, okay? The market has already anticipated and priced in what it perceives to be the full Fed tightening cycle. And I'll show you a chart at the end here. But the fact that the yield curve, it doesn't look like this. It really looks like this. It's pretty flat from 2 years out to 10 years. That's the market telling you, we don't think the Fed is going to tighten dramatically beyond what they're forecasting to do, and we're also not concerned about these levels of inflation persisting deep into the future. So even though you're seeing these negative returns on bonds, and again, there's no escaping the fixed income math. When rates go up, bond prices go down. Based on TD Economics forecast, the damage is already done. So I think from this point on, you're probably looking at low single-digit returns on fixed income through the rest of the year.
Can I ask a question?
Yeah.
And we can defer this to later if we, on the discussion on reporting. But if I wanted to look in a snapshot how our 75% allocation in equities did, where do I see that?
You see it across the, like on page 10, you see it across the individual holdings.
But it's not, I guess my question would be, isn't it, like if you go to your page 4, you do the allocation, well, you have it aggregated, large cap, you know, et cetera. I guess at some point or somewheres, it would be good to see equities performance aggregated and bond performance aggregated.
I understand what you're saying, Dana. Yeah, I'll do a little digging on that.
All right.
It's in summary form. The last thing I just wanted to point out on this deck, if I ask you to just turn to page 40, 3 pages from the back, 41.
41?
Yep, should be the third to last page.
Yep.
Yeah. Look at the very bottom right. I just wanted to show you a snapshot of the yield curve, just to illustrate what I was just talking about. So what you have there is that green line, and this is as of March 31st, is, if you look at the x-axis there, it's the overnight rate all the way out to the 30-year rate, and these are U.S. Treasury yields. So it's in the lighter green color, it's showing you just a few weeks ago, and then it's showing you a year prior in the darker green color. And so, like I said, the Treasury market has essentially completely priced in the Fed tightening to roughly 2 to 2.5%. Now, does that mean it's a precisely accurate predictor of what the Fed's going to do? No. Even the Fed doesn't know how far they're going to tighten. But you can see when I say the damage in fixed income is probably done, it's reflected in that very flat line. And then just on the bottom left, that's the 10-year U.S. Treasury going back to May of 2020. So almost a couple of years worth of data there. And you can see the dramatic increase that we've seen, from 1.5 to north of 2.5%. It's about 2.90 today. Just year to date. So with that captures everything I really wanted to share with regards to the portfolio and an economic update. If there's any questions, we'll deal with that. Otherwise, I'd say let's go to the ESG discussion.
We can look just really quick at the Prescott Park piece because it is a really good one.
Yes.
What page?
31. Just so that everyone understands, the difference in the allocations a little bit, just in looking at it.
Yeah, so let's look at the table on the far right, and I will, just going to reference the first one that we looked at. So large cap 51.94% versus 51.91% for the other 3 portfolios. In this case, it's all in the S&P 500 fund, okay, versus the 10% allocation to value. So you got that differential, and again, that was because we were trying to drive more income for the other portfolios. In terms of SMID cap, we've got a 10% allocation versus 5, because in the other portfolios, that other 5 is going to the REIT holding. And then the only other differential is high yield is a little bit less, 5.7 versus 7.6. Again, we were trying to drive income in the other portfolios. And over this less than 1 year time period, in the first quarter of this year, it underperformed the other portfolios by 44 basis points. And then since inception, it's about 50 basis points, but it's the starting time period is a little bit different. Prescott, even though it shows 528 on here, the investments weren't made till 6/1 or 6/2, so there's a little bit of a timing difference there. Does that answer your question, Judy?
It does. I guess my question, and I'm just kind of throwing it out, is out of all of our investments, I mean, we religiously spend, you know, a significant amount each year in transferring funds over to the city to help the maintenance of the park. And it's.
From the Prescott Fund you're talking about?
Yes, and where it's slightly underperforming the other investments, I don't know if that's something that the trustees might want. Oh, sorry. Sorry. I don't know if it's something that the trustees want to look at, or if there's a reason why we've got it invested in those allocations the way that we do, but I mean, if we're spending $180,000 every year approximately out, I mean, and it's slightly underperforming how the others are. That's my question to the trustees, kind of.
Yeah, so I would only interject that this is a really, well, the differentials, if you look at the quarterly differential, it's quite small. This is a really short time period. With, you know, it isn't, you can't project this performance long-term. If we were looking at a year prior, this would have been the higher performing portfolio because the S&P 500 outperformed the, you know, value dividend stocks. That said, in light of what the opportunities are in the market, I don't have any objection to aligning the portfolio, you know, aligning the models for the portfolios if that's a more consistent approach.
I'm just
Yeah.
throwing it out there because anybody that would look at this can see that there's a difference, and that's just kind of what I'm just asking the question. Obviously, if the trustees are comfortable with the allocation as is, then we will continue down that path. I was just asking the question.
And I'll just add, if we were to implement the tactical changes, we actually would be adding a large value allocation to Prescott, so that would, more than anything, more closely align them.
Yeah,
What do you think, Dana? Just leave it as is?
yeah. Where would you do, take S&P down to 40%, add
Exactly.
10%?
Yep, exactly.
Yeah. I'm just curious, typically, I mean, how often are you making portfolio allocation changes?
So we have not made any changes since inception. As part of our original investment agreement, the trustees need to sign off on any
No,
changes.
not us, but in general, TD Wealth with your clients.
Yeah, so with the majority of institutional clients like yourselves, we are implementing TD's asset allocation changes, you know, no less than once a year.
Yeah. Overall, I'm not a big fan of making portfolio allocation changes. I know this market is a little bit dynamic, so, I mean, I think this is a fairly, if we did that, it would be a fairly minor change, and I would have no objection myself, but
But if
I
you-
just didn't want to see every time we meet with you another
yeah.
change in allocation.
We can wait another quarter, Dana. I mean.
No,
see
I
how-
mean, I understand what you're saying. What were the other changes you would be recommending?
Yep, just taking international down to just a few percent, down to 10% from 13. Taking high yield down a few percent from like 7 to 4, and then not overweighting corporate bonds. as we are today versus treasuries.
So what gets an increase from what you're taking down?
Yeah, in this case, in the case of treasuries, I could do it one of two ways. I could add an all treasury ETF, or I could add exposure to another passive bond strategy, the U.S. government aggregate bond index, which has like a 60% weighting to treasuries versus 40% for corporates. So all consistent with, sort of the passive ETF, low-cost approach that we're employing in the portfolio, just taking the corporate exposure down a little bit.
So are these recommendations for every portfolio?
Yeah, I
Yeah.
mean, 3 of the models are identical, and there's no reason not to express them in Prescott as well.
I don't know. What are you guys feeling on this?
Well, let me ask you, when we were discussing Prescott, you said ordinarily if the market was where it was in the large cap equities, that we wouldn't see the result we're looking at. And so the question is, are we going to be back here this time next year saying we shouldn't have made that adjustment? Because
Oh, how I wish I could
give
answer
me a
that with
crystal ball.
certainty. Yeah. I guess I'd tell you this. TD, as an organization, has an asset allocation committee whose job it is to constantly analyze market conditions and make recommendations to the portfolios that we manage. We have, all of our institutional clients have custom portfolios. You have investment policy statements. They're not managed by a model. But we do have what we call TD managed portfolios, where those portfolios automatically get changed based on the tactical decisioning of the asset allocation committee. Some of my clients like to express those changes in their portfolios. Some don't want to. That's entirely up to the client. I do support making, probably at least once a year tactical changes to the portfolio in light of the fact that the environment changes and you're paying TD to hopefully add value with regards to these changes. None of the changes that we're describing are going to allow you to dramatically increase your budget or force you to decrease your budget based on what the market does. You're still going to have a 75% allocation to equities and a 25% allocation to fixed income. These are changes at the margin that will hopefully add value, and that to me makes sense in light of the environment that we're in. Obviously, we can't go back in time and change the portfolio. So I do support them, but I won't lose any sleep if we decide not to make any changes either. If you said, John, if you had to pick one, I'd probably dial back the corporate exposure on the fixed income side, because the exposure to spread widening is, we don't know. If the stock market really starts to suffer this quarter, and then all of a sudden the Fed gets nervous and takes down their projections of how far they're going to raise rates, spreads will probably come in, because the market will, again, be reaching for yield. But if inflation continues in a way that doesn't seem to be abating, and the Fed continues to speak hawkishly, and history suggests that the Fed typically tightens into an economic slowdown, that to me suggests that spreads have probably a higher risk of widening than tightening. But again, we're not talking about eliminating high yield. We're talking about reducing it from 7% to 4%. So, but I'm supportive of all of those slight adjustments, and it would more closely align Prescott with the other 3 portfolios, which you might find beneficial.
Again, I was just asking the question
Yeah.
because there is a difference. I can see that there's a difference.
No, that's a good
So,
question.
Ultimately, if you want to leave it, that's fine.
Again, not change, still 75-25, still in conformance with your investment policy across your exposure to asset classes, just changing the allocation a little bit.
So a related question is, you say that typically you would look to adjust accounts for investors once a year, at least once a year. When would that normally take place in your year?
It's going to be entirely dependent on the client and the market conditions. The Asset Allocation Committee produces their update every month. I tell you, half the time they're unchanged, right? So maybe 6 times a year they're making slight adjustments, but the markets and the environment does change meaningfully, on a yearly basis. So as to when, I guess I'd say put it this way. I wouldn't wait for a meeting like this to recommend a change if lights were flashing red or there was some compelling opportunity. It really depends on market conditions.
Okay.
I felt like I interrupted you.
Well, I was going to say the market conditions would drive
Yeah.
it. We wouldn't wait until, if we waited, the opportunity would pass.
Well, and ultimately, this would lead to a conversation I anticipate having at the end of the discussion about when we should be having these meetings. So I'm not trying to time the market, but I am trying to get an idea of how often we should be realistically looking at this conversation and adjustments. So if we do something now, what's the opportunity to reverse that or go in a different direction if the market starts moving quickly?
Well, what I would suggest is that if something dramatic were to occur and we think that something needs to be changed in the portfolio, we wouldn't necessarily wait for a meeting. We would pick up the phone and call you.
Okay.
Maybe we need to have an ad hoc discussion and say, can we make these adjustments? Have a 15-minute WebEx or conference call and make our argument as to why we think that change needs to be made. And
If you're more comfortable, we can always wait until we're a full year in. I mean, technically, we're not quite a full year in yet, I mean, as far as this current investment mix. So, I mean, Again, I was just asking the question.
That's not really what I'm trying to do is figure out how we're going to do this going forward as much as anything else. So we really have sort of got to the point where we're 10 months in, but it took a long time to do adjustments, get the monies to you and everything else like that. So, as far as the issue right now is I'm comfortable with your recommendations. What are you thinking? Hesitant about it, Dana?
I'm not hesitant. I'm on the fence. I mean, I don't think it's going to significantly change much.
Well, either do I. That's why I just look at it as tweaking.
In general, on principle, I don't like changing asset allocations.
Then let's
And it's
not.
only, but he has some valid points. And your point is, you can see on the margin what the difference does make on the two portfolios. So, I mean,
the argument I would make is that you've engaged us as a discretionary partner. And this allows us to demonstrate the value that we bring to the table.
yeah.
John is a brilliant advisor. I have the privilege of working with him. He has a lot of expertise behind him, and I have
You've got to
full trust.
pull the mic down.
You really want to listen
Thank
to
you.
me?
Can you say brilliant again, please?
I would just, you hired us for a reason. Let us do.
Yeah.
I
Go ahead, Peter.
I guess I would say the same thing. If we don't like what you're doing,
You'll tell us.
we'll tell you, and if you don't improve, we have the opportunity to change. And if we hire you, we hired you for a reason, and that was to bring us your expertise. And currently, I want to follow your expertise.
Okay, so you ready to fall off the fence, Dana?
Yep.
All right,
I'm ready.
so let's go ahead and make those adjustments.
Thank you for the direction there.
John, when you take down international from 13 to 10%, where's the extra 3% go?
It'll go to domestic, and it will go to your large cap core, so your S&P 500.
On the 3, but on the other one, you're going to add 10% value on the Prescott?
Right. So, yeah, it'll be allocated across those.
Okay.
Yep.
Okay.
Okay. ESG.
Oh, wait, excuse me, one more
Yes.
question. When you taken the 13 to 10 down on international, are you staying in emerging markets at all?
Yes. It'll pro rata get cut down, but I won't take it to 0.
Okay. I keep it, but good, do your thing.
ESG.
Before we start into it, can you walk us
Precisely.
how, like, what exactly is
How can we help?
leading us to this discussion and how we can address it best for you?
Well, this first came up during the process that when we were first retaining you, where we had a citizen reach out to us and said, what is the city going to be doing about, ESG investing, getting out of carbon and that type of thing. And, at the time we said we're just going through this process. I think we had a brief conversation with you early on about, what type of sacrifices might we face if we decided to jump into that pool. And we also reached out to the charitable trust, the division of the Attorney General's office that manages charitable trust and that type of thing, and got some opinions from them. And then most recently, Dana happened to come across another town that is jumping into that pool, so to speak. And so we thought, now that we've got about 10 months under our belt, it's a good time to have that conversation, because I suspect we'll be asked that question again in the near future. That's the background, really.
Okay. So, well, you want to go or you want me? Well, we talked earlier about the potential sacrifices and benefits of engaging in ESG investing. There are costs to it and potential sacrifices in yield. Depending on the mandates you want to pursue, you have the risk of making certain residents in the city happy, others residents maybe not so happy, depending on the mandates you're pursuing. So that's one perspective. Alternatively, there are ways of engaging ESG strategies that are pretty benign, that kind of make everyone happy. So I'll let John talk about some of those that are sort of, kind of make everyone feel good and address your investment needs at the same time.
So I guess the best way to answer that is there are products called ESG aware. So similar to what we're constructing the portfolios from today, passive approaches, index-based approaches, similar to what we're doing today with an ESG aware label to them. Now, what does that mean? It means that whether they're relying on Morningstar ratings or MSCI ratings, right, there's a database quantitative database assigned to thousands of companies where the companies are rated on various criteria, from the environmental impact that they have to their social and governance policies, their sustainability policies, say, the makeup of their boards, gender makeup, minority makeup, et cetera, right? And they've quantified this and assigned a number to every company, and then portfolios will be constructed to try to tilt the portfolio towards higher rated companies. Does that make sense in terms of what the products are doing? As it relates to the report that you shared with me, those were all Morningstar labels. And so I looked up the Morningstar sustainability rating for all the products that we're using today in the portfolio. This is a 0 to 5 scale, and the vast majority of them were 3. As an example of the S&P 500 index fund that we're using, which has a sustainability rating of 3, there is an ESG-aware Russell 1000 ETF product that we have, which is, from a risk-based perspective, U.S. large cap risk, essentially identical to the S&P 500, has a Morningstar sustainability rating of 4. Okay, is that the objective? Is that what the goal of your ESG investing would be? I can't answer for you, but that would be one way to approach it if you wanted to measure yourselves against, say, a Morningstar ESG rating.
How would you feel about that?
So in the case of a U.S. large cap fund, I wouldn't try to talk you out of it. Cost-wise, it's 14 basis points more expensive in terms of its internal expenses versus the 1 basis point that you have today. So, you can probably call that that's your expense difference. Performance difference cannot be predicted. As you would expect, many of the ESG-aware ETFs will underweight energy, carbon producing. That would have caused them to outperform up until 2021, where the energy sector was by far the highest performing sector and is one of only 2 positive sectors year to date. So I don't say that with any judgment, good or bad. It's just these are the nuances of the market, right? And so we have to accept drift, if you will, from the benchmark. It's not going to precisely track it. There's going to be periods where it's going to do better. There's going to be periods where it's going to do worse. So if that were a way for you to achieve the goals that you're thinking about in this regard, I wouldn't have any issues with that. Similarly, in the bond space, there is an ESG-aware U.S. aggregate bond passive ETF, 7 basis points more expensive in terms of its internal expense ratio. Performance has been identical. There hasn't been a meaningful performance difference. So I wouldn't have any issues there.
And what would the ratings be on that?
Again, 4. It would take
4
from 3 to
versus
4.
the other one's 3?
Yep. However, so just 2 caveats. In light of the time horizon for the funds and the fund's objectives, if you were to tell me, John, this is extremely important, we need to get to a Morningstar sustainability rating of 4 for the whole portfolio, I am confident, based on the products that TD offers, that we could do that for you, consistent with a passive kind of low-cost approach to investing, get you broad exposure to the markets. Where I would be challenged is in the high yield space, for example. I think I'd struggle to come up with a solution there. And then small cap could be another one. So I'd have to do some work there, but at the same time, those allocations are small enough within the portfolio that over the infinite time horizon, I don't think you would look back 20 years from now and have regret over that decision just based on the sizing of mid-cap and high yield in the portfolios. But it's just a consideration, right? I wouldn't necessarily be able to deploy that strategy across all the asset classes, which would force us to either eliminate them or just, live with a lower rating there.
On the large cap core, it was, the fund we're in is 1 basis point
The expense ratio is 1 basis
versus 14 basis points?
versus 15.
15 basis points, which is still, okay.
Yep. For what it's worth, which may not be much in the context of your preference for passive strategies, what some of my clients do, for example, I work with a Boys and Girls Club that doesn't want to hold any alcohol, tobacco, or firearm stocks in their portfolio. I can't do that through a mutual fund or an ETF that's going to contain broad exposure to all the names in the index. I can only do it by virtue of having them in a separately managed account that is just wealth industry nomenclature for, it's not a pooled product like a mutual fund. In a separately managed account, the client sees all the individual stock holdings, and then what I can do is I can exclude I can exclude Philip Morris to never be purchased in the portfolio. I can exclude an entire industry like alcohol or firearms. So that's a different way, in a more precise and direct way, to express an ESG preference, but it's entirely different from, it's a higher cost solution because separately managed accounts are more expensive, but it does allow you to more surgically eliminate exposure to either certain industries or certain names. So I just want you to know that's an option that we have.
Has TD developed a ESG fund?
Not in, no proprietary fund. What we have done is, you may remember going back to the early days, I described our platform as an open architecture platform, meaning we have our proprietary products, and then the majority of the products I have at my disposal are what we call best-in-class third-party products. You don't have any proprietary TD products in the portfolio today. We have been largely expressing our ability to meet clients' ESG needs through third-party products at this point.
As a bank, we're doing a lot of ESG. We've seen.
Dana definitely knows that. And then just lastly, and this isn't to sway you one way or the other, but in the small cap space, just one data point, we offer a fund that has underperformed the passive strategy that you're in by 200 basis points over the past 10 years. So that's not a great result. It's got a 4 rating.
What was this fund in?
It's a small cap.
Small
It's
cap.
small cap. Yeah, and half of that underperformance is due to cost. So your ETF is a 6 basis point expense ratio. This fund has a 94 basis point expense ratio. So that's one, in light of this discussion and kind of how we've described it, I'd probably avoid that one. It's, that's 94 basis points is a tough hurdle to overcome cost-wise. Yep. But in the U.S. large cap space, in the U.S. aggregate bond space, and in the developed international space, we can definitely get there.
To 4.
To 4. Does that help in terms of at least sort of framing the product opportunity set? And
It does. So what we've been advised by the Attorney General's office is that that our fiduciary obligation to the city is to, manage the funds for not necessarily the highest possible return, but balancing risk and that type of thing for an appropriate return. That if we were to simply decide we want to just get into all ESG investments, and it resulted in a significant lesser return, that would not be appropriate. If we were a private fund that, for instance, the Boy Scouts or something, in which certain investments would be contrary to the purpose of our organization, then it is appropriate to, give up some of the return in order to stay pure, so to speak. And so, so from my perspective, sort of coming into this, you've been very helpful in coming up with that 3 out of 5, because I had no idea what our current portfolio is. So I'd be interested if you could sort of elaborate on that in a report or something, just a one-page summary or something like that, because I think that would be helpful to our citizens who say, well, where are you at? So we can say, well, this is what it is. So I think the gray area is, and this is a conversation for the three of us, is it worthwhile pursuing ESG investments for a slight loss?
I wouldn't assume that would be the case.
Well, I'm not assuming anything. But if you're talking like,
You know the cost is going to go up. You don't know if the performance is
Right.
going to be better or worse. And we will only know that in hindsight, looking back. I wouldn't expect it to be significant one way or the other for U.S. large cap and the U.S. aggregate bond index, just based on what I've seen, the composition of the portfolios. They're not different enough to get to a super meaningful difference. So I don't think your performance, it might be better, it might be worse, we'll only know in hindsight. It won't be significant. Your costs will definitely be higher, but not, we can define what significant is. Or
Yeah.
you can tell me what significant is. But yeah, there will be a little bit of a cost.
but the change in, the difference in return might be market issues, not the nature of the investment. Right, I mean, it could be whatever that line is or something, just loses interest in the market. But that's how I summarize it. So what's your thinking on it?
Yeah, I think it'd be good to benchmark our portfolio on the Morningstar now. If you could go through, which I guess you've done already, just so we have a starting point and we can have our discussion from there. As you say, if someone asks, are we sensitive to ESG? We can say this is where our portfolio is today. And amongst us, we can decide if we want to do anything about it.
Yeah, I'm not just pursuing this to give out to somebody in case they ask us, are you being good people? I think I'd want to look into that type of stuff, but I feel my fiduciary obligation is not to do so at the cost of a significant return
Yeah.
on the portfolio. Peter, you have thoughts?
No, I think that's good.
All right, so let's do that at the beginning, and assume that we may want to come back and have this conversation next time. I don't think we'll change anything at this point, but I think having the base for what our current investments are doing. And I would say, if you, subject to your thoughts on it, if you see the market develop so that there are products in that area, in the ESG, that are not additional cost and look like they're likely to have same or similar return, I'd be interested in hearing about them when you come in again.
ESG has evolved over the last 25 years tremendously. I mean, it started years ago, really with the founder of Domino's Pizza, who is a ardent Roman Catholic and was trying to find ways to assist Catholic organizations who were subject to the U.S. Conference of Catholic Bishops, who had very specific rules for how they should invest their portfolios, and they didn't have a place to go. So he provided seed money to create the Ave Maria funds, and they were the first sort of mutual funds that complied with the rules. Very expensive and very time consuming, because they had to sit there and weed through all the different securities to make sure they complied with the rules. But more and more funds added on. Calvert got in with the environmental ones and things like that, and people started to catch on. They're adding on and on and on, but what ends up happening is there's no uniform definition for various mandates and what have you. So you have to look very closely at each fund to see, okay, this one says it's about, the mandate is, no carbon emissions. Well, this one is 100% no carbon emissions. This one is only 10% of the revenue can be carbon emissions. This one allows companies that only 25% is carbon emissions. So, it becomes a very slippery slope, and you have to look really carefully as to which companies are allowed in it and how strict do you want to be. And so there are companies whose their sole job is to sit there and score these companies. And so we have one client that not only do they have a third-party manager that has positive and negative screens on their portfolio, but then they have another outside firm that scores all the companies within it to double-check everything.
Yeah, but people in Portsmouth, at least my impression is, have known about this for a while. The original sort of socially appropriate investment was Pax World, which was started by a couple of UNH professors in Portsmouth. And so there are people around here who have been in that fund for many years. So I think it's an issue it will become a bigger issue with our citizens once they,
But
get around.
you're both referring to actively managed funds, Pax World or Calvert funds.
Oh, no,
In my case, I would not ever want to give up on passive
no.
strategy.
That's certainly, I just use Pax World, the fact that people around here are familiar with this. And so, no, I don't think we want to change our basic approach and investment strategy just for this. But the first step is I do think we should be prepared to discuss it with people, and that's why having that type of a report would be helpful. But I do think this is going to continue to be a developing thing in the market. There will end up being some uniform scoring that will allow you to really judge these companies. You got companies out there, particularly in the energy sector, who say they're carbon, but they really just go out and buy a bunch of credits in order to get there, and they're still producing carbon. So I just think this will probably be an ongoing conversation that we'll have over time.
I agree. We're having this conversation more and more and more with clients, so it's definitely out there. But then the challenge is with passive, the whole idea with passive is that you get the full basket of the market. So it's a...
Yeah, but, if you can increase your ESG responsiveness by a third, going from 3 to 4 without sacrificing your passive strategy or performance. I agree performance is, paramount, but you can do it on the large cap core and the bond fund, something to at least look at.
Absolutely. So we have some homework.
Okay. All right. Let's talk about the summary reports.
Yeah, so again, just going back to the beginning of our conversation, when I looked at everything that was in the reports that you sent me, I can provide all of that information, but it's in different places. For example, your monthly statements actually contain some of what you were looking for. So I can't manually create something for you that doesn't exist on my system, but I can work with you to create a document that
I think that I can do a dashboard based on the documents I get from you. I mean, what you provide to me is very informative, and I go through them every month, line by line. So I think what basically was being looked at is that, to be honest, your predecessor had a dashboard, and it had everything on it for a one-page snapshot. And I think the trustees were wondering if it was something that you could system generate so that I wouldn't have to go in and monthly manipulate and create a dashboard for you.
Listen,
Correct me if
we
I'm
don't-
wrong.
We don't want to have to take this report and manually come up with what our total investment, we should be a cover sheet that
Is that
says.
the monthly one?
Yes.
Yeah, I'm honestly, I almost prefer not to get that because it doesn't help me at all.
You know, I mean, I don't know why you shouldn't have the ability to do a cover sheet that says this fund, the three different funds and what the total is. This month, year to date, quarter to date, you know, I mean, this is not helpful.
That's your essentially your custody statement. That's a monthly account
I
statement.
don't want a custom statement.
Custody, yeah.
Oh, okay. I want, and we've been asking for it for several months.
Yeah, so I can't create for you something that my system doesn't automatically generate.
Our compliance team is very strict. They will not let us generate anything manually.
So what's the theory behind that? That you'll mistakenly calculate the rate of return or something, or?
Yep. Or not put the proper disclosure or disclaimer or the proper numbers. But we'll look at our system again, make sure that we're not missing some sort of report that's out there that we haven't pulled.
I'll make sure, I mean, I can sit with the trustees and I can devise something with them. I mean, obviously, they need something that they're not getting. So, and if it's something, another report monthly that I need to get to give them the full snapshot of what they're looking for, then
Yeah, but
What can I give you to make that
I'll
process
have to go
as
back.
easy as possible?
I'll have to go back and look and see what's missing from the month, because I like for what I do, I like the monthly report I'm getting.
course,
But
yeah.
I'm down in the nitty-gritty of it. It's easier for them to have a snapshot of the big picture, so.
I understand. One question I had is the percent changes that you had indicated on the dashboard. Are those intended to be actual net of fees, total rate of return calculations, or is that
They
just
were
a simple
the bottom.
change?
They were just the bottom line, fair market
Yeah.
value across the board for them, just so that they could kind of see a snapshot of what the percentage change is.
So that isn't a figure that any of my systems would even produce, but easy enough to do in Excel, which I think you built it in, so, yeah. Yeah, so let's just work together to, one, come up with a report dashboard that meets the trustees' needs, and then two, how can I best and most easily and efficiently get you the data that you need to put it in?
Okay, sounds like a plan.
So there's just no way you can produce that type of a summary report?
If I could push a button and replicate, believe me, I'd be telling you I could.
So, 'cause it just seems like this is going to be as much work for you as it is for Judy. We're trying to get this off her back because she's not our dedicated employee. She has other jobs as well. So if you're going to be sending her an email or something with numbers that you've extracted off of the report, now I've got you spending a bunch of time doing something for her to spend a bunch of time. It just doesn't seem efficient.
No, but I'd like to get to a point where we figure out how much time it really is, because if we organize it properly,
Well, it might just be, I mean, what I have right now, honestly, for what I give them, I mean, I have my calculations built into my formulas, and I just go and I change my numbers, and it calculates across and then populates a graph. So, I mean, once it's set up, it just would be the setup of it and formulating exactly, what it is that they want, if anything further. So, and a lot of that I get off of the reports I already get. So, but I will reach out, I will figure out.
We'll set up, yeah, let's set up a time to go. I'd like to see that
That's
spreadsheet, and
Yeah.
maybe there's a couple of tricks we can deploy, and
All set?
All right, so, any other thoughts on that before I have one other question?
Just one, Tom.
Yep.
My last thought on reporting for you to take away. If you, back to page 4, on that right hand, on the asset allocation side, which is great, I think what we're looking for, if we could see performance down along the same side, of each of those asset allocations. Or similarly, on page 8, where you have each of them individual performance, if it could be aggregated to equities, cash, bonds, total
I've got a note on
performance.
that.
Yeah, okay. That'll get us close to what we're looking for.
When you're
And that
talking,
would be a quarterly report that you were looking for that on, or do you
Yeah, I
have it
mean,
on
it'd
the
be great if it'd be
monthly?
monthly, but I mean, quarterly, certainly
Yeah.
perfect.
so my last question, we talked about this in the beginning, and you saw we've included this in our investment policy. We'd also like to do some comparison to peer groups. I don't know when a good time to do that would be, in January for the prior year, or in July or August for the prior fiscal year, but now that we're coming up on a year, is that something that you could do for us? Would you be able to access what, for instance, New Hampshire Charitable Foundation and places like that?
Well, I can tell you that NACUBO, which is the National Association of College University Business Officers, they just released their survey from 2021.
Okay.
So the tables just were released, so I can pull those numbers and get those out to you.
Sure, that'd be great. Any thoughts on who you'd want to see as other peer groups? Of course, you're going to be comparing us to Harvard and Yale.
Yeah, right.
No, what they do is they break it down. They break it down in cohort groups. So they do the entire universe of 800 college and university endowment foundations, but then they break it down by 25 to 50 million, or under 25 million, and 25 to 50 million, 50 to 100, and so forth. So it's broken down according to performance in 1 year, 3 year, 5 year, 10-year performance. Then they break it down by asset allocation as well.
Yeah, well, so the reason, it wasn't so much the value, the total account value, it's just, I know in most of those large university endowments, the private ones, that they can hold on to individual stocks like Apple or, Tesla or something like that. And so a lot of those get a major payout when those stocks appreciate and they're sold. And obviously we don't do that. So it's an apple-orange situation.
Yeah, some of them have a lot of private equity, but the under 25, when you look at the asset allocation, you'll see that they don't have the allocations to private equity and holdings like that.
Okay. Well, I would like to see that. That would be helpful. But I would, I know in the past we've had various peer groups, and I think of the New Hampshire retirement system. We looked at, I think,
I can look and see what we used to compare
Yeah,
to.
I think I might have it too. when
Okay.
We had
If
4 or
can
5
get
of
our
them.
hands on it,
Yeah.
and maybe give them samples of what it is that.
Yeah, we'll,
So that you know.
yeah, we'll try to do that, to get that to you, and if you could think about maybe after June 1st, do it for the fiscal year,
Sure. That'd be great.
that would be, that would be helpful. Other comments, questions? Dana?
No, good.
All right,
Thank you all for your time.
appreciate it.
No, thank you. Good to
I
see
have
you.
some homework to do. Judy
Yeah.
will follow up. And,
Absolutely.
We'll take it from there. Good to see you too.
Where'd you stay last night?
I mixed it up and I went to the Sheraton.
Oh, okay.
Yesterday I got lucky. I was the first person to drive my rental car, and I think I was the first person to stay in my newly renovated room.
There you
Really?
go. You're the good luck charm.
Oh yeah,
Do
I
you
got
want to
lucky.
call the meeting?
What time did you come in?
Or are we gonna talk?
John, these quarterly?
About 5:30.
That is a custom.
Okay, so the road was open then.
Oh yeah, everything was open, wide open.
I can
I landed in Boston at 3:30.
This anytime?
I couldn't get into Manchester. I think I know why now.
Yeah,
Yeah, all the flights were sold out. So
Yeah.
I think the press corps took all of it.
everything in there is
all my seats.
it's a one-off report that I can.
Well, and-
update on.
Why is Manchester so popular? Why can't we get in? Now I know why.
Unfortunately,
When's our next meeting?
I can push a button and produce it.
yeah, we need to set up some meeting. I'm
Do you
gonna
have
do
a
that after
standard
they.
quarterly report?
There's just 100 different reports that
You choose from.
I don't want to do Thursdays.
Sounds like Tuesday's gonna be our lucky morning. All right. We don't have anything set in May, right?
We do not.
All right. So Wednesday and Fridays don't work. Wednesday, Thursday, Fridays don't work. How do your Tuesday mornings look?
Mine are fine, I can make it work.
Okay. All right, so we either, in May, we can do the 17th or the 24th?
Let me just check both those. 17th.
Yeah, good.
Okay. June 14th?
May, what did we say?
17th.
May 17th?
You guys are too fast for me.
That's because I just write them down on a paper and stick them in the...
Yeah, that's what,
I do know, just to let you know, that this room is used by the city manager for her core group meetings at 9, so we would need to be done by 9.
Yeah, that shouldn't be a problem.
During the summer, it's usually when we run over, is when we have someone come in, so, just an FYI.
Okay. And we pretty much have to use this because of the recording equipment and everything? Okay.
June, what, 14th, you say?
June 14,
let's see, July.
July 12th? or
Well, let's do the 19th.
Oh, wait a minute, hold on, I might have a problem in July. Trustee meeting, June 14th. I'm slow. July. What day did you say?
19th is better, I think.
19th?
Yeah.
Does that work for you,
And,
Dana, or is that a problem?
I'm out of town
All right.
I'm out of town the 14th through the 9th, through the, I don't know, 13th through the 19th.
Okay.
So the 12th
Yeah,
is the 12th okay with you?
not really, but I'll make it work.
Is that okay with you, Judy? or-
I'll make it work.
All right, July 12, and then let's pick the August one, and that would be the 16th.
Yep.
All right,
Good.
okay.
August
good.
16?
Yes.
Yep. All right, any other new business? Then I'll entertain a motion to adjourn.
So move.
So moved.
I'll consider that a second. All in favor? Aye.
Second.
Done.
Yes,
Thank you very much.
I'm focused here on my